If you think silver crossing $100 per ounce is just another market milestone, you are about to realize you've been only half told the story. Today is Sunday, 25th January 2026, and the number that everyone is talking about, silver at $100 per ounce, is only the surface of a historic fracture in the global metal markets. The real story is that silver prices on paper are telling one story, and what buyers are actually paying for physical metal in us, major markets, is telling a completely different story. What you're about to hear is not clickbait, not speculation, not recycled commentary. It's a fact-based explanation of one of the most unusual and structurally significant events in commodities this decade. On 23rd January 2026, silver officially broke above the $100 per ounce mark on the COMEX futures exchange, extending a rally that began in 2025 and has surprised even seasoned market analysts with its speed and breadth. This rally has been driven by a combination of factors that go far beyond normal cyclical price moves. Tight physical supply, record industrial demand, geopolitical uncertainty, unusual retail investment trends, and structural changes in how silver is priced and traded globally. Analysts who follow commodity markets closely describe this surge as historic and, in many ways, unprecedented in terms of speed and fundamental disconnects. But here's the fundamental truth most commentary misses. The price that is being quoted on a futures screen, the COMEX price, is not the price that major buyers in Tokyo, Dubai, or Shanghai are paying for actual physical silver right now. In fact, in many delivery markets around the world, physical silver is trading at prices implied to be well above $120 and even approaching $130 per ounce. This means that the variation between what the futures market quotes and what real metal trades for in hand is not just a narrow bid-ask spread. It is a massive divergence that in some markets exceeds 70 to 80% above paper prices. This is not minor. This is a structural break in how prices are being discovered in the silver market. To understand why this divergence exists, we need to step back and clarify a key distinction in commodities markets: the difference between paper silver and physical silver. COMEX prices represent futures contracts, essentially financial agreements traded on an exchange that promise delivery of silver at a future date, but in practice, most of these contracts never end in actual delivery. These contracts are influenced by liquidity, trader positioning, hedging strategies, macroeconomic flows, and sentiment. They are financial claims, not necessarily representations of physical metal in hand. Physical silver, on the other hand, is the real metal: bars, coins, and bullion that can be touched, delivered, stored, and consumed in actual industrial processes. This is the silver that manufacturers need for solar panels, electric vehicles, high-efficiency electronics, medical devices, and a countless list of industrial and technological applications that simply cannot substitute away from silver's unique physical properties. When someone in Tokyo or Shanghai buys a 1,000-ounce bar, they are not buying a contract. They are buying metal that must be sourced, refined, transported, and stored. The price of that metal reflects actual supply and demand for deliverable ounces. Now let's examine the forces that have created such a wide gap between futures pricing and physical pricing. First and foremost is the structural supply deficit in the global silver market. Unlike gold, which is primarily mined as a metal of value and investment, silver is mostly mined as a byproduct of copper, lead, and zinc operations. That means even if silver prices rise dramatically, mines cannot simply ramp up silver output because their economics are driven by the production of base metals. Current estimates suggest that the silver market has been in structural shortage for multiple consecutive years, with global demand outstripping supply by tens of millions of ounces annually. This structural deficit has accumulated over time, drawing down inventories and leaving less metal available for delivery. This long-running deficit results in a real physical scarcity that is now showing up in the price premiums dealers charge for physical metal. While futures markets can trade based on speculation and liquidity flows, physical markets cannot function without actual ounces. In major bullion trading hubs, dealers are now charging significant premiums, sometimes 50 to 80% above paper prices. To reflect the difficulty of obtaining and delivering actual metal, these premiums are not limited to small retail coins. They exist for 1,000-ounce bars, wholesale orders, and institutional offtake agreements, signaling that the scarcity is broad-based across market participants. Adding to the supply challenge is the recent policy shift by major producers, especially China, which has introduced stringent export licensing requirements for refined silver in 2026. These controls effectively limit the amount of metal available for international trade, diverting a significant portion of refined silver to domestic industrial use and reducing the free float available for global buyers. This policy move has tightened the global pool of deliverable metal and intensified regional premiums. Inventory figures tell a similar story. Registered inventories that portion of metal available for delivery against futures contracts have declined sharply over the past few years. In markets such as COMEX and the London vaults, inventories have reached multi-year lows, with COMEX registered inventories shrinking dramatically from earlier levels. This inventory depletion means that there is less metal available when futures contracts require delivery, putting upward pressure on physical pricing and making it harder for arbitrageurs to reconcile prices across markets. The end result is a price breakdown in the traditional price discovery mechanism that historically kept paper and physical prices in close alignment. A defining technical condition emerging in this environment is called backwardation, where the price for immediate delivery of physical silver is higher than prices for future delivery contracts. In normal commodity markets, futures prices trade at a premium to spot prices because of storage and carrying costs. But when demand for immediate physical delivery far outstrips supply, as we are seeing now, spot and very short-term prices can exceed futures prices significantly. This backwardation is a direct signal of tight physical availability, and it reinforces the divergence between physical and paper markets. So why hasn't this huge gap simply disappeared through arbitrage? In typical conditions, when buyers can profit from price discrepancies, they would buy cheap metal in one market and sell it where it is expensive, eliminating the gap. But that mechanism requires sufficient physical metal to move. When deliverable silver is scarce or locked up in industrial commitments or export restrictions, arbitrage becomes impossible at scale and the gap persists. Industrial demand plays a major role in all of this. Unlike investment demand, which can fluctuate with market sentiment, industrial demand for silver tends to be inelastic. It doesn't drop dramatically just because prices rise. Silver's unique conductivity and reflectivity make it essential for solar panels, electrical contacts, circuit boards, RF connectors, and many cutting-edge technologies. As global renewable energy deployment accelerates, and as electronics and electric vehicle manufacturing scale up, industrial demand continues to soak up large portions of the available supply. This means that even if prices rise, factories and manufacturers must still buy silver to keep production running, further tightening real supply. The result of all these factors is that the silver market today looks fundamentally different than it has in recent history. Instead of one unified global price that balances paper and physical demand, we now have a bifurcated market. One price for futures trading and another for actual deliverable metal. This bifurcation is not a minor technicality, it's a structural fracture. In Asia and the Middle East, physical premiums have soared as buyers compete for scarce available metal. Meanwhile, futures traders in Western markets find themselves pricing contracts based on liquidity and sentiment, not real-world physical pressures. This divergence has significant implications for investors, industrial users, and financial markets. For investors, it means that the price you see on a futures ticker may not reflect the true scarcity or utility value of physical silver. Someone buying metal to hold in allocated storage or for use in manufacturing is experiencing a very different market than someone who buys or sells futures contracts electronically. Understanding this difference is essential for anyone trying to interpret price movements or make informed decisions in the current environment. There are risks associated with this fragmented pricing environment as well. One possible risk is that if a significant number of futures holders suddenly demand physical delivery instead of closing their positions financially, the market could face acute delivery pressure. While most futures contracts are closed out or cash settled before maturity, a systemic shift toward delivery demand could strain the already dwindling registered inventories even further, potentially forcing prices higher or causing liquidity stress in futures markets. Another risk is that persistent divergence undermines confidence in paper pricing mechanisms. When traders and institutions start to see physical premiums as the true price signal, the value of futures pricing as a benchmark could weaken. This shift in confidence could amplify volatility and lead to broader market dislocations over time. Despite these risks, some analysts believe that this environment also presents opportunities. For example, physical ownership of silver, whether through allocated bullion, coins, or other deliverable forms, may offer a different risk-reward profile than exposure through futures or unallocated paper instruments. In markets where physical premiums are rising, long-term holders of real metal may benefit from scarcity dynamics that paper markets do not capture. It is also worth noting that not all commentators agree on the future path of prices. Some warn that the rapid rise to $100 on COMEX could be overheated, driven by speculative momentum rather than long-term fundamentals, and could see corrections at times when sentiment shifts or liquidity changes. However, even those more cautious voices acknowledge that the structural supply constraints and physical demand pressures are real and distinct from purely speculative price moves. So where does this leave the silver market as of January 25th, 2026? The narrative is clear. The silver market is not behaving like a typical commodity price cycle. It's not simply rising because of short-term sentiment or technical trading patterns. It is rising because the physical availability of silver is under stress, and the mechanisms that once balanced paper and physical pricing have been strained to the point of near breakdown. Buyers in major markets are paying premiums that far exceed quoted futures prices just to secure deliverable metal. That tells us something fundamental about the reality of scarcity and demand in the global market. What traders, investors, and observers need to watch next is whether this divergence persists, narrows, or reverses. If physical prices continue to outpace paper prices, it could signal a real transformation in how silver markets operate, potentially leading to a revaluation of silver as both a commodity and an industrial metal. If the gap narrows because supplies improve or inventories are restocked, that will tell a different story. Either way, today's market is far more complex and structurally significant than the simple fact that silver hit $100 per ounce. This is the real silver story of January 2026. Not just a milestone price figure, but a global market in the midst of deep structural shifts. Supply deficits, physical premiums, bifurcated prices, industrial, demand pressures, and policy changes have created a unique environment that is rewriting how silver is valued around the world. If you want to understand markets and the forces that shape them, this is one of the most important developments to follow. Thank you for listening. I am Kevin from Boring Currency Info, and this is how informed viewers understand today's silver market in its full economic and financial complexity.